Hello. My talk today is about the financial impact of exposure to prior disasters from a corporate perspective. It will be based on a recently joint paper with my colleagues, Dr. Onur Tosun and Professor Gulnur Muradoglu, which has recently been published in the British Journal of Management. As we know, the COVID episode had a remarkable impact on, and of course, very negative impact on the finances of companies in various sectors of the economy, in particular on the sectors of hospitality and travel. And entertainments, amongst others. The impact of COVID on the stock markets and equity markets has been described as a black swan event, which brought down the stock market indices together and in an unanticipated way, especially in the first few months of the outbreak. And then there was a subsequent recovery of lost market ground over the subsequent months. So the fundamental question that we ask in this paper is the impact of the COVID episode on companies in various sectors of the economy with respect to their exposure to similar crises in the past. So again, as we know, many countries around the world almost went into recession, or in fact, actually did go into recession as a result of COVID and then the government expenditures during the COVID period. So it was quite a significant event from a financial and economic point of view, as well as, of course, from a health and public safety point of view. It is clear, as mentioned, that certain sectors of the economy, such as air travel, tourism, hospitality, suffered far more heavily than others. But still, if you look at other sectors of the economy, there is a widespread cross-sectional difference or variation in the way companies responded to COVID and to its financial turmoil. So even, for example, if you take the manufacturing sector, or if you take the services sector, even when you zero down on a particular subsector of the economy, still there's widespread cross-sectional heterogeneity. And what we like to do in this study is to understand the drivers of that heterogeneity. So what makes companies behave the way they do? And we argue that we have found at least one of the factors that contributes to this cross-sectional difference, and so far has not been studied in the literature. So as we know, in behavioral finance literature, there have been a significant number of studies that look at how individuals' prior experiences, particularly experiences in their early life, in their childhood, teenage years, and early adulthood, will have an impact on their financial decision-making several decades later even. So for example, in this Journal of Finance paper, which was published in 2011, called Overconfidence and Early Life Experiences, the authors show that those CEOs who in their early life were exposed to the Great Depression of the late 1920s and early 1930s. And they, when they become CEOs further in their careers, they are more averse to debt, and therefore the companies they lead have far less debt on their balance sheets, so a different capital structure, and their companies lean more excessively on internal finance. So this is one illustrative example of how what has happened in one's childhood or early teenage years might have an impact several decades later in one's financial psychology, if you like. So the question we ask in this research is whether a similar mechanism can happen with companies. So whether companies collectively, when they're exposed to external factors, to disasters and threats, whether they can also learn, or their collective behavior, which is in fact a major function of the mindset of their managers, but also their employees and workforce, whether firms or organizations collectively can learn and adapt as a result of being exposed to similar crises. So in a sense, a bit like vaccination, you could argue. And in the paper, we use the term immunized firms in reference to firms that have been exposed to similar crises. There is also a wide literature on the spillover effects of being exposed to terrorist attacks in financial markets. Terrorist attacks of various sorts have a negative short-term impact on equity markets, but also have a sustained long-term impact as well. And there's a body of literature that delves into this, and our study also contributes to this literature as well. So fundamentally, we ask, do firms with prior exposure to disastrous events experience a better or more favorable, or perhaps less negative market reactions during a more recent phenomenon? And the more recent phenomenon we look at is the COVID pandemic. Now, in terms of the prior event, we focus on the 9/11 attacks, which happened in New York City, where, of course, the World Trade Centers were under attack, but also other major buildings on the East Coast of the United States. We examined firms which were headquartered in New York City and traded in one of its 3 stock exchanges. And as such, these are firms which were exposed to the dramatic and unanticipated effect of a sort of black swan event, up close and personal during those days. And in fact, the similarities between the 9/11 attacks and COVID are deeper than one might appreciate at first glance, because at first glance, one is a terrorist event, the other is, of course, a health pandemic. But if you dig deeper, you will see that, for example, during 9/11, the airspace on the East Coast of the United States was shut down for a number of days. And as we know, during COVID, air travel was equally suspended or made far more difficult. Of course, although for a much longer period, during 9/11, there was a similar, although again, more short-term, shock on the supply chain of companies, and workforce in New York City, for example, was unable to work in offices So they were grounded at home, which is very similar to what happens when the lockdowns happened in different parts of the world. And so there are some similarities in that respect. So what our findings show is that firms which were exposed to 9/11, i.e. firms which were headquartered in New York and traded in those exchanges and then survived, they displayed more financial resilience. So they're, at least from the stock market performance point of view, their returns were better compared to similar companies which were not exposed to 9/11. The group of firms which were exposed to 9/11 and survived the subsequent 2 decades were found to be, in some sense, more immune to the financial hit of COVID, such that their stock price losses were, on average, about 7% lower compared to firms that were not exposed to 9/11. So this 7% on average is statistically significant, of course, but also economically significant. And it would correspond to billions of dollars of markets, of less market stock market loss compared to peer group companies. Not only that, but also the trading volume of these firms increased due to buying pressure in the markets. So it seems to show that investors were more eager to buy and trade stocks of firms which had the experience of a similar event in the past, being exposed to a similarly unanticipated dramatic event, even though, again, categorically, a terrorist event which is not similar to a health pandemic at first glance. And these results are consistent across various industry sectors and across various specifications. So the period we focus on is from the 9th of December 2019 to the 30th of April 2020, which includes 2 months as treatment and 3 months as control periods. Both those firms which were exposed to the 9/11 attacks and our control group are similar in every respect, other than the fact that one had the experience of 9/11 and one didn't. So, for example, their industry classifications are very similar. In both groups, about 60% of the firms are financial firms, followed by around 10%, which are service, etc., etc. So, so this reassures us that we're not picking up a major difference that could be driven by other factors other than this differential impact because of exposure. Of course, we control for this in multiple other ways as well. So we measure abnormal returns using 3 different estimation windows: 3 months, 6 month, and 9 month window, and then use different conventional models for estimating returns, including the 5-factor Froment-French model. As you can see from these preliminary results, regardless of the event window and the estimation window that we look at, there is a significant difference, statistically significant difference between the market response of immune firms and control firms, such that, as you can see, immune firms do better or do less bad compared to control firms. This is the equation that we effectively model in our empirical analysis. Our dependent variable is market reaction, and our variable of interest is an interaction between two dummy variables. One is immune, which is one if the company has been exposed to 9/11 and 0 otherwise, and then post, which is one if the observation happens after the events and 0 otherwise. So it's equal to 1 for the 2-month period starting 2nd of March and 0 otherwise. We also control for market returns for different risk factors such as SMB, HML, RMW, CMA, market value itself, to make sure that we're not picking up a size effect, for example. And as you can see, the return and the excess return both load positively on the interaction term of interest. Again, statistically significant and economically significant. And this goes to show that those firms did far better, or at least less negatively compared to their peers. You can also see that their trading numbers are significantly higher, whether you look at traded volume or dollar volume or signed volume. So again, it seems to suggest that the market has some sort of memory and investors value the experience of being exposed to dramatic events in the past. So if a company has been through a couple of crises in the past and has survived, investors appreciate that and are more keen to buy those companies as opposed to their peers. And we pick this up both through their returns and through their trading. So in conclusion, the exposed firms have stock prices which experience lower losses during the COVID episode compared to firms that were not exposed to 9/11. And of course, we could have done this for other major shocks as well, but it was very interesting to do this for the 9/11 attack due to the similarities I mentioned in terms of New York and East Coast of the US, the experience they had with 9/11. And in fact, with COVID, again, it was the East Coast of the US which experienced the COVID pandemic early on, and then it sort of spilled over to the other parts of the United States. So as we showed, the trading volume of the exposed firms is higher due to buying pressure in the markets. Of course, there are several other tables and robustness tests in the actual paper, which you're welcome to take a look at. And our results are consistent across various industry sectors and are robust to additional COVID-specific risks. So we want to make sure that we're not picking up any risks or any factors. So we want to make sure that this difference that we observe is not driven by anything that is COVID-specific. So borrowing from the literature, we control for those COVID-specific risks which could drive asset returns. and have been established in the literature. And as such, this study contributes to the literature, which examines the market reaction of companies to the spread of diseases. It goes back to the original paper of do stock markets catch the flu? So its impacts, the impact of common flu, for example, or the impact of other health pandemics such as SARS, etc., on equity returns. And then it also contributes to the literature on market reaction to terrorist events, given, of course, the prominence of 9/11 as a terrorist event. And it also engages with the literature that looks at market memory by providing evidence that markets have long-term memory, because there is about 2 decades of time lag between the first event and the second event, and yet investors are able to price in the success or failure of firms in extreme events, and this in itself is quite interesting. So thank you very much for your attention, and if you're interested in the paper itself, please look it up in the British Journal of Management under the title of the keynote. Thank you, and good luck.